Hey everyone, welcome in. What's good? This is another edition of Market Takes. Listen, I know you could have been anywhere in the world, but you're here with me and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal. This is Market Takes. Today we are getting into breaking out today's U.S. retail sales report. We're going to talk about all sorts of things, what the report showed, how that compared to expectations. Of course, we're going to get into the market reaction, take you through what stock markets, bond markets, currency markets, commodities, all that did in response to today's report. It wasn't a whole lot. We want to break out the nuance today. We're going to talk about some of the other data that we've seen and how this report mixes in to give us a picture of what's going on in the economy and the way markets are reacting to that. And we're going to talk a little bit about what to expect coming up at the Fed's June meeting and what the markets expect from the Fed's June meeting. We are also going to look forward, talk about what comes next, because you know we are always looking forward, even though it's backward-looking data. So listen, the U.S. retail sales report for February showed a 0.4% month-over-month increase in retail sales, a 1.6% year-over-year increase. Let's first off throw up here on your screen what we saw from the retail sales report. Now, this is the month-over-month change. As you can see, for the past 5 months coming into this report had been negative. Those numbers, when you see the bars going down, that shows a negative print, and then that January print starting to look more and more like an outlier. But you see the latest report on your screen, the latest bar there showing an increase 0.4%. So a little bit confusing when you look at the month over month, right? It seems like we were headed in this definitively downward direction, but then we got this month, picks it up. Things get a little clearer when you look at the year over year chart. I want to throw that up here on your screen now. Now, this is a much clearer chart, right? You see very clearly over the past 6-7 months, just lower, 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 consistently lower numbers when you see that retail sales. So year over year, we are seeing the number decline in terms of the growth of retail sales, the growth of purchasing, the growth of what U.S. consumers are going out there buying. And this year over year retail sales chart just very clearly illustrates the theme that we have seen from that retail sales report going back for a little bit of a time now. So when you unpack that report, when you want to get into the details, there is a clear trend, and it's one that the Fed has been warning about and been talking about really going back 3, 4, 5 months now to their meetings at the end of last year in 2022. And that is an increase in services spending, a decline in goods spending. And we're seeing that even out and where inflation isn't really going away, but it's not picking up either. So when we look at this report, we saw a big increase in spending online. Non-store retailers up 8% year over year. Food services and drinking places up 9.4% year over year. Furniture and appliance stores down. A big decline in gasoline spending. So what are folks spending on? Not those home goods, not gasoline, not those things that had been picking up during the pandemic and rising significantly through last year and into 2022. We saw that huge spike in gasoline prices. Those things are going away, and what we're seeing now is an increase in spending online, increase in going out and drinking, eating at restaurants, things like that. Health and beauty stores up 7.9%, while electronics and supply stores down 7.3%. Services inflation is picking up. We're seeing folks spending more money on those things like services, less money on things like goods, and the Fed has been worried about that because they're seeing, even though inflation is coming down consistently, what's picking up is these other things that are less affected by the pandemic and are more affected by the recovery. So we are recovering from that pandemic era and prices are picking back up, but you're not seeing the effects of their interest rate hikes on these things because we're still seeing increasing spending. This means that's a little good and a little bad, right? Because the report shows, okay, the U.S. economy isn't falling off a cliff. People aren't tapping out. Consumers aren't saying, all right, you know what, I'm done. I'm going to stay home and not spend money. But that's a little bad because that's what the Federal Reserve wants. The Federal Reserve doesn't want you going out spending money. Federal Reserve doesn't want you taking out loans, buying new things for your home, going out spending money on beauty supply, going out getting a manicure, pedicure, you know, doing things like that. The Fed wants you to stay home, stop spending, so these prices will come back down, and U.S. consumers are not obliging. So, like I said, a little good because it means that we are not moving into that recession that some folks had feared, but Also, that recession that some folks have feared is the thing that's going to get the Fed investors think to start backing off these rate hikes and start cutting rates as they're expected to do through the rest of this year. So let's take a look at how the markets are responding and reacting to this retail sales report that we got. I want to put up here on your screen, you're seeing right now the current state of the market. You've got stocks all in the red, but just by a little bit. You saw the NASDAQ actually went and got positive a little bit earlier in the day after something, I'm not even quite sure what happened, but we've basically sent that off and ignored it. So NASDAQ, just like the S&P and the Dow, in the red right now. We look at the bond markets. That's where we see the clearest reaction in response to this retail sales report we got. So I'm looking at the 10-year note right now. You see 830, boom, just a rocket ship higher, but only about 4 basis points. We are consistently moving up from that though. And you see it across the board here. You see it in the 7-year, you see it in the 5-year, even going up to the 30-year note. You see yields rising up here, meaning inflation expectations getting high, growth expectations getting higher. This retail sales report, I think, was just, the bad news isn't happening. We're not seeing another month of declining retail sales. You look at the currency markets, the euro going negative against the dollar means the dollar is picking up. A little bit of those worries we're starting to see. The Japanese yen also rising. Those are signs of worry in the market. You're not seeing a real strong pickup here for anything in the currency market. What I do think is interesting, though, is what we're seeing in commodities. Now, you're seeing oil holding above $70 a barrel. You're seeing gold holding above $2,000, moving down a little bit negative today, but overall things not really changing that much. So the market really illustrating that investors not particularly convinced that things have changed, no material change to the overall trajectory of things, and markets reacting to that. Now, a big piece of what we got coming into today, and when we were looking at the data today, one thing I told you guys to look out for yesterday on Market Takes as we were looking forward to the week's data was this Home Depot earnings report we got this morning. Home Depot projecting sales will fall between 2 and 5% this year for fiscal 2023. They had previously expected a flat sales, saying, okay, we think we won't make a lot of money, we won't lose a lot of money, but overall sales are going to be consistent. Well, now they're saying, okay, decline to 2 to 5%. That's important as we look out into the overall economy, where we are seeing a pickup of more bearishness. And Home Depot is not just saying, well, we think our sales are going to decline. They're saying, based on what we've seen, based on what we saw in Q1, how that aligns with years past that we've seen, we are expecting a decline in our sales 2 to 5%. Now, here's another reason why that's a big deal. This is the first time that Home Depot has said this, and this would be the first time their sales have declined since 2009. So every year since 2009, Home Depot has been able to make money, increase sales year over year. This year, they're saying for the first time since 2009, we think sales are going to fall between 2 and 5%. That's important. And here's why it actually gains a little bit of increased importance. We are seeing this really across the economy. The Fed's Beige Book that came out last week showed, quote, lending volumes and loan demand generally declined across consumer and business loan types. Really, when folks aren't getting loans, when they aren't getting that credit, they're not able to grow their business. And we're seeing this especially for smaller businesses and even some larger businesses. But we have seen a lot of big businesses, big companies be able to issue bonds, come out in the debt markets and be able to raise money that way. But companies that aren't able to access debt markets, those small businesses, really are having to go without or deal without being able to get more money to boost themselves and to grow and to pay off their employees. A lot of them are facing some tough times and they're not able to get credit right now. And that's what we saw from the Fed's Beige Book. New York Fed's latest survey of consumer expectations showed the share of respondents reporting that it's harder to get credit climbed to the highest level on record. That goes back to 2013. We are also seeing rising use of credit cards and consumer debt. The Fed's latest consumer credit report showed an increase of $26.5 billion in March. That was $10 billion more than expected. We've got credit card debt reaching an all-time high, right as credit card interest rates are reaching an all-time high, which means the amount it's going to take to pay back that money is the highest that it's ever been. That's big and that's important, something to keep your eye on. Also, New York Fed's April survey of consumer expectations showed inflation expectations declining for 1 year ahead, but increasing for 3 and 5 years ahead. Inflation expectations are important because it guides consumer behavior. When folks think inflation is going to rise, they behave that way. They go out, they buy a lot more, they demand higher wages at their job, things like that that push inflation higher. especially when folks are saying, okay, well, I think maybe inflation won't be as bad this year, but I think longer term inflation is going to be higher than I had originally thought. Well, that changes behavior. And you're seeing that with the New York Fed's April survey of consumer expectations rising, but again, still below that 3%. But we also saw it in the University of Michigan's May Consumer Sentiment Index. Now, we also saw short-term expectations rising in that survey, but long-term expectations rising over 3%, 3.2%. That is important because the Fed's target is for 2% inflation. If consumers and regular everyday folks like you and I are saying, I expect inflation over the long term to be 3%, well, that makes things a lot harder for the Federal Reserve. That also goes with another worrisome trend. I want to put another chart right up here on your screen, and that is the University of Michigan's consumer sentiment. You see there that line just moving lower. Consumer sentiment dropping to 57.7 last month. We are seeing weaker sentiment around current conditions and future expectations. So not only do folks expect that inflation's going to get higher and continue to rise, they are saying they think things are going to get worse for them. They think their sentiment is going to get worse. They think their prospects for getting a new job that pays more, for maybe their business being more successful, those things are getting worse. They feel worse about the state of the economy. And that chart really just illustrates how consumers are feeling right now, which is not so great. What does that take us to? That takes us to a very, very important meeting for the Federal Reserve next month. Of course, we're going to be breaking down on market takes, but we've got a little bit of time before that. So let's talk about what happens at that June meeting. This is where the rubber meets the road, as folks like to say, because the market is projecting the Fed is going to start cutting rates at its July meeting. There's currently a 26% chance, so better than a 1 in 4 chance, the market is seeing that the Fed cuts rates in July. Now, that comes after 500 basis points of Fed rate increases that we have seen really just over the past year. The Fed has raised rates at really the fastest pace in history when you consider how low rates were when they started and how high rates are right now. And now markets are saying, okay, we'll take a pause in June. They don't think that the Fed is going to raise rates, but then expecting at least in July, they're going to start to signal that they're going to start to cut rates because a lot of rate cuts are priced in through the end of the year. We're talking about 3 rate cuts from the Fed. That is boosting market sentiment. That's got bond prices being held down. That's got stock prices going up. And that expectation, if it gets disrupted, could be a major market changing event. You could see a lot of moves in the markets across assets, and that would be big. So watch out for what kind of signs we see from Federal Reserve policymakers. Just recently, we saw Fed President Loretta Mester saying that she doesn't think rates are high enough. And if the market starts to really take wind, she was the second Fed Reserve President or Fed Governor in recent days to say, we're not done. We think maybe rates could go even higher than they are. The market so far has shrugged them off. If we get a hawkish message at this June meeting, that could be a major disruptor for markets. Really, inflation data and the data that we got today has not given any reason for the Federal Reserve to cut. This retail sales report, remember, retail sales are up only half as much as expected, but still an increase in retail sales, meaning even though inflation is still at 5%, folks are still going out spending money, still spending more than they did last month and more than they did last year, even with 5% inflation. That shows there's not a lot of reason for the Federal Reserve to cut rates in the next month or two, in the next 2 months, I should say, as the market is kind of predicting right now. And the market is certain that by the end of this year, the Fed will have cut rates at least twice. There is a 0% expectation right now when you look at the Fed Fund futures market for the Fed to keep rates where they are. There's only expectations for cuts. No one expects them to raise rates. And if they do that, expect some real turbulence in markets. And that could mean some real turbulence for the U.S. economy. Keep that in mind. A lot of folks are talking about the debt ceiling, and that's big. That could make a big difference. But you're really going to want to watch out for that June Fed meeting. That's when we could see a lot of action in markets. This retail sales report just shows, like I said, that inflation is not going away and that folks are still going out and spending, even with inflation, more than double the Fed's target. Listen, what does that take us to? That sets us up for a lot of housing data that we are going to get next week. I will be here with you on Monday talking about what data we've got coming out through the rest of that week, but we will get the NAHB Housing Market Index on Tuesday. Housing starts on Wednesday, existing home sales on Thursday. Housing is big because housing prices have been rising, as we talked about yesterday on the look ahead for market takes. 3 things you need to watch out for, right? I told you what we were going to get this week. We are getting those 3 big reports this week. You're going to want to watch out for all 3 of those. We also get the leading economic indicators report on Thursday. That I think is going to be big. It's going to tell us a lot about the economy, and the weekly initial jobless claims. I explain why all of those are important in this week's look ahead, but you'll get all those reports throughout the rest of this week. And of course, like I said, be here with us on Market Takes as we do our look ahead on Monday, talk about what you need to watch out for next week. Hey, listen, man, I am Dion Rabouin, reporter at the Wall Street Journal. This has been Market Takes. I know you could have been anywhere in the world, but you were here with me, and I thank you for that. We'll do it again on Monday. Hope you'll be with us next time on Market Takes.